All right, today we are going to be talking about the difference of checking accounts, savings accounts, money market accounts, and CDs. Traditionally, in the world of finance, these are called banking products or basic banking products. Okay, and they're FDIC insured. I'm going to go through with you the differences and what to avoid because there's some things that sound similar to them, but they're not the same. So let's jump right into it. Checking account is just something that you literally go open up credit union, bank, local bank. You can do an online bank account as well. It's just for day-to-day money where you actually transfer money out or write checks if some of you guys still do that. But it's like if I go to pay a bill, it's coming out of my checking account. Okay, so it's more for like day-to-day expenses. Typically, people ask me like how much should I have in there. When you look at your emergency fund, like if you have like a 6-month emergency fund, you typically have like 1 or 2 months of expenses saved up in checking because most of the time they don't pay or if they do pay, very little interest. Most of them don't even pay interest. Okay. So the money's not really doing anything for you. It's just sitting there. But it's something to pay bills out of. So that's your checking account. Okay. Savings accounts, there's a couple different versions. Your typical traditional savings account is one where you earn interest on your money, but there's restrictions on it. So like you can't transfer money to pay your bills out of it. You can't write a check off of it. So back in the day and with banks, what they would do is they would have your checking account that had no interest, and then your savings account would have a pretty decent interest rate on it. Okay, and that's the way that they worked. And then whenever you needed money, you transfer from savings to checking. That is kind of gone to the wayside since 2008, and the reason being is because the savings accounts weren't really paying any interest, so no one was putting money into them. Now they are. Okay, so your traditional banks might only pay like 1.5%, but you can go online and get like an online savings account. They call them high yield savings accounts, and you can earn like 4.5% on them right now. So typically, what we look at is stuff like, okay, well, if I have a 6-month emergency fund, put 2 months in a checking account and the other 4 months in a high yield savings account. So you can do that. Okay. Again, the main difference is savings accounts, you can't pay bills out of. You have to transfer the money into like that checking account in order to do that. Okay. That brings me to the next account is a money market account. These used to be really, really prevalent. Before 2008. The reason being is because they typically used to pay more than savings accounts, and you could write 3 checks a month out of them. That's the way they used to be. Nowadays, I don't see them around as much anymore. Just simply with banks, that is, simply because you can have high yield savings nowadays. So that the high yield savings account is very similar to a money market account. It's kind of reduced the need for it. I see money market accounts more on like brokerage accounts from like Fidelities and whatnot. So like if you see like a cash sweep account or something like that they call it, that's a money market account. The key thing on all these things, so checking, savings, and money market account, they're all FDIC insured through a bank. So you have insurance. So if like the bank goes bankrupt, you don't lose your money. I bring that up because there's also something confusing when it comes to money market accounts, and that is a money market fund. Okay, a money market fund is not the same thing as a money market account. I wouldn't put my money in a money market fund. There's no reason for it. I could just put it into a high yield savings account, or I could put it into a money market account that's FDIC insured. So I would never put my money in a money market mutual fund or a money market fund. So you would have to know the difference on that if you're looking into that. So those are the first 3. The last way you can store your quote unquote cash is through CDs, or certificates of deposits. Okay. And what these are instruments where you put your money in for a certain amount of time, and then it pays interest over that time. So typical time periods are like 6 months, 12 months, 18 months, 2 years, 3 years, 4 years, 5 years. Typically, the longer you hold it in the CD, the more interest you're going to get. Okay, that's typically how it works. So let's just say you go into a 1-year CD paying 4.5%. What that means is I would put in, let's say, $10,000, and I would let the money sit there. And at the end of the year, I get my $10,000 back, and I make $450. That's what a CD is. You can take it out early. So let's just say in 6 months, I had an emergency and I needed to take the money out. You can break the CD. If it is broken, then you have to pay a penalty, but the penalty cannot go into your principal. So like if I go in and I put in $10,000 and 2 months later, like I need that $10,000 back and the account has like $50 of interest on it, the bank would keep the $50 in interest because I broke the CD, but I get my original $10,000 back. So basically with CDs, there's no risk of losing principal on them. And so a lot of people will use them, especially within their emergency fund. They will say something like 2 months in cash, like 1 or 2 months in a savings account, and the other 2 or 3 months, they'll do like a 1-year CD or a 2-year CD, or maybe they ladder CDs. That's where you do different terms. So that way their money's earning a little bit extra on the CD. Either way, however you do that, there's so many different ways to set that up. Like whatever you feel comfortable doing. Personally, I use CD ladders with my emergency fund, just because I'm always constantly rolling them over. But that's the other thing I need to let you guys know about CDs too, is you have the option when you put it in the CD, you can say like, yes, pay me my interest on my CD and cash it out when it's done, or you can just keep rolling it over, give it that option. So you'll want to know what that is, because different purposes. Some people that use it for an emergency fund, they just keep letting it roll over into the next one. Some people that are doing it for a purpose, like I just talked to someone yesterday. They were putting money into a 3-year CD because they were going to be using that as a down payment for a house. They don't want the rollover, so you got to make sure you tell the bank don't roll this over when it comes due. And there's an option for you when you buy the CD. So, like I said, those are your typical banking products where you put your cash at. You could do it at your bank. You could do it at a credit union. You could do it online on like a online bank account, and even some broker dealers that do investment stuff like Fidelity and stuff. They have them also. So it just depends on where you're at, what you feel comfortable with doing. That's the video on that. Talk to you guys soon.